Hi, everyone. This is Dr. Kenneth Ta. Today, we are going to consider Chapter 1. Chapter 1 is an overview of financial management and the financial environment. An overview of financial management and the financial environment. In this chapter, we are going to introduce ourselves to different topics that we are going to cover in this course. Some of the things we are going to talk about in this chapter are forms of business organization. We'll talk about the objective of the firm, the reason why we are in business. Straight front, we can state clearly that the number one reason why we are in business is to maximize shareholders' worth, the maximization of shareholders' worth. We'll talk about the determinants of fundamental values, and we'll also talk about financial securities, markets, and financial institutions. Why is corporate finance important to all managers? Corporate finance provides the skills that is needed to add value. So once a manager, an individual study corporate finance, they are able to identify and select corporate strategies and individual projects that add value to the firm. So we are talking about investment decision. They're able to make sound investment decision. Corporate finance also provides the skills that is needed in focus of fund requirement for a company and help the manager to devise strategies for acquiring those funds. So this is financial decision. So corporate finance help with number one, investment decision, the ability to select projects that add value, and number two, financing decision, the ability to acquire funds. There are three basic forms of business organizing. When a business is formed, that business can either be set up as a sole proprietorship, or it could be a partnership, or it could be set up as a corporation. So we'll talk about these different forms of business organizing, their benefits, and their disadvantages. Starting with proprietorship. Proprietorship is basically a business that is set up in a way that an individual is in business for and by themselves. So it is an unincorporated business that is owned by one person. It's owned by one person. Most businesses in America are proprietorship. In fact, about 73% of all companies in America are proprietorship, but they tend to account for less than 5% of all sales revenue. There are unique advantages to having your business as a proprietorship. For one, the ease of formation. It's very easy to form a proprietorship. Number two, proprietorship are subject to few regulations. Proprietorship generally don't collect money from the public. They don't raise funds from the public like corporations do through the issuance of shares. So because proprietorships don't raise funds from the public, they are subject to few government regulations. Another advantage is corporations benefit from the payment of, they do not pay corporate income taxes. So no corporate income taxes. Corporate income taxes is just for corporation. So there is no double taxation as far as proprietorship is concerned. The disadvantages, number one, limited life. Proprietorship are very tied to the life of the owner. When the owner is not alive, that becomes the end for most proprietorship. As a result of that, we usually will say that proprietorship tends to suffer from limited life. Another disadvantage is unlimited liability. This is even worse, unlimited liability, which means that the liability of a proprietorship extends to the proprietor's personal wealth. It's not just limited to the amount of money that the proprietor has invested in the business, it extends unlimited liability, which means that in the event of a lawsuit that finds a proprietorship a very large amount, beyond the amount of money that is invested in the business will be liquidated to satisfy that liability, and then additional money can be recovered from the proprietor's personal wealth. So the proprietor's liability, we will say, is unlimited. It's unlimited, which means that the proprietor is taking a high level of risk in running a business as a proprietorship. Another disadvantage is the difficulty to raise capital to support growth. A proprietorship is an individual that is in business by themselves. They don't have partners that they can raise money, they can bring more money on the table. They are not able to raise money from the public through the issuance of shares. So a major disadvantage is the difficulty to raise capital to support growth. All right, the next form of business organizing is a partnership. A partnership is two or more persons or entities that get together to form a known corporate business for profit. So two or more persons or two or more entities coming together to form a known corporate business for profit. So partnerships tend to roughly have the same advantages and disadvantages as a sole proprietorship, which means that in comparison with a corporation that we are going to talk about shortly, they are relatively easy to form. They are subject to few regulations. They don't pay corporate income taxes. Disadvantages compared to a corporation, they tend to have limited life. They suffer from unlimited liabilities. It's difficult for partnership to raise capital. They are not allowed to issue stocks, so they can raise capital from the public. So these are some advantages and disadvantages of partnership that is very similar to those of sole proprietorship. Limited partnership can be formed in such a way that there are two types of partners. There are limited partners and general partners. Limited partner could be someone that just put money on the table, but they are not involved in the day-to-day running of the partnership. So in that case, their liability is limited to the amount of money they have invested in that partnership. On the other hand, we can have a general partner that runs the day-to-day business of that partnership. So the liability of a general partner becomes unlimited liability. All right, the third form of organizing is what we call a corporation. A corporation is a legal entity that is separate from its owners and managers. So a corporation is a person in the eyes of the law. Is a separate legal entity. It is separate from the owners and from the managers. So a corporation is formed when paper filing is done with a particular state. That is the process of incorporation. There is a charter that is being filed. When we talk about the charter, it includes information like the name of the corporation, the activities of the corporation, the amount of capital stock, the number of directors, the name and addresses of directors. So all of that appear in the charter. We also have bylaws that is being filed. A bylaw is a set of rules. Example, what is the rules surrounding the election of directors? If existing shareholders can buy a new stock, what is the rule about that? What is the role or procedures for changing the bylaws? All of that is captured in the bylaws. So when a business is incorporated, a charter and bylaw is being set up. What are the advantages and disadvantages of a corporation? An advantage, a corporation enjoys unlimited life. This makes sense when we think of a corporation as a separate legal entity, which means that it tends to, it's separated from the shareholders, separated from the owners. And as we know, corporations tend to have many owners. So if one owner is no longer available, it doesn't mean the end of that corporation. So it's a legal entity, it's separated from the owners and it's separated from managers. So as a result of that, most corporation tends to be there for a very long period of time. So we will say the benefit from unlimited life. Another major advantage is the ease of transfer of ownership. A number of you own shares, which basically imply you own a certain percentage of a company. But it's very easy for you to sell your share. You can sell it at any time through a broker. So that's why we say it is easy to transfer ownership. That's an advantage. Another advantage is limited liability. This is a huge one, limited liability. The liability is limited, which means from the shareholder's perspective, the amount of money that they can lose is limited to the amount they have invested in that corporation. So their liability of the business does not extend to their personal wealth. Another advantage is the ease of raising capital. We've already talked about this. So for corporation, they can easily raise capital through the issuance of stocks. They can issue bonds. So when they are in need of money, it's easy for them to raise money from the public. The disadvantages of corporation, number one, there is double taxation. Double taxation is a huge disadvantage. So corporation pays corporate tax. So if you think about it from the, again, perspective of the shareholder, once a corporation makes profit, they need to pay taxes to the government. Then if they pay dividend to shareholders, shareholders need to pay taxes on the dividend they have received. So there is a corporate tax and then there is a personal income tax. So that is double taxation. Another disadvantage of a corporation is the cost of setup and report filing. It's a high cost of setup. To be incorporated, there's a lot of costs that is being incurred. The company needs to hire an investment bank, so they need to pay a commission. They need to hire accountants. They might need to hire lawyers to help with the incorporation process. A lot of paperwork is required, the charter, the bylaws. So all of that makes a huge cost to incorporate a business. All right. The next thing we want to talk about is becoming a public corporation and growing afterward. So most businesses begin as a closely held corporation, and then later on they need to extend to becoming a public corporation. So we already mentioned that they need to prepare their charter, their bylaws. They need to file a prospectus with the Security and Exchange Commission. Then they need to be listed on an organized exchange, either the New York Stock Exchange or the NASDAQ. So the process of incorporation includes what we call the initial public offering of stocks. This is when the company is raising cash by issuing shares to the public. And this process allowed the founders and pre-IOP investors, we mean friends, families, private investors, venture capitalists that had invested in this business when it was a closely held corporation. So these people are able to harvest some of their wealth because now it's going public. And the business is selling ownership to other people, is opening up their ownership structure to other people. So that's what we mean by initial public offerings. The first time a business is opening up its ownership to the public. People can buy stocks for the first time. So subsequently, there can be the issuance of debt and equity through a process for equity that we call seasonal offering, which means that the company can later on still sell additional shares. But IPO is a very important process for most companies. It's a whole process. They hire an investment bank. The investment bank goes on the roadshow to get a feeling of an appropriate price for the stock, develop that price. We see, based on research, that most IPOs tend to be on the price, which means that they don't sell at their true intrinsic value, and then later on the price tends to go up. This means that the company that is going public for the first time is losing some money, which also suggests that a strategy, investment strategy, can be built around IPO, and one can make some money because, again, most IPOs tend to be on the price. But that is the process of moving from a closely held corporation to a public corporation. It begins with an IPO, initial public offering. All right, let's talk about agency problem and corporate governance. The very fact that the corporation is a separate legal entity can pose problem. Most of the time, the shareholders tend to hire managers to act in their best interests. But when these managers come in and act in their own interests and not on behalf of the owners, not on behalf of the shareholders, it poses a problem. And that problem is called in finance agency problem. So agency problem is when the agent, in this case, manager, act in their own interest instead of the interest of the shareholders. There are just different types of examples of agency problems in most businesses. Could be a manager using corporate money to buy the most expensive jet that is used for their private vacation. That is maximizing the manager's wealth instead of shareholders' wealth. That is an agency problem. I'd heard of it. A terrible one. A manager was hired, came in, and reconstructed the bathroom in the office and put a toilet pot that was made up of gold. So they are maximizing their wealth. They are using corporate money in lavish purchases at the expense of shareholders. So this is agency problem. One way that agency problem can be mitigated is by putting in place a sound corporate governance. A corporate governance is a set of rules that controls the company's behavior towards its directors, managers, employees, shareholders, creditors, customers, competitors, and the community. So a set of rules. These rules are put in place and it guides the operation of the business. Everyone is going by those rules. It helps to minimize agency problem. So sound governance is going to control agency problem. All right, another thing we want to talk about is what should be management's primary objective. When you come into a company and you are the manager, one of the managers, what is your number one objective? Are you there to maximize your personal wealth? Of course, no. Are you there to maximize the wealth of the community? Are you there to maximize the betterment of the employees? We will want to argue that the primary objective is to maximize shareholders' wealth. That's the reason why we are in business, is to maximize shareholders' wealth. The business is owned by the shareholders. So we run a business to maximize their wealth. This translates into maximizing the fundamental stock price. So if stock prices are going up, shareholders' wealth is going up. So management wants to run the business in such a way that prices tend to go up. Does that mean that the firm can behave unethically? No. There is a need to run the business in an ethical manner. Does that mean that the business have no responsibility to the society at large? That is not the case. We have some responsibility to the society at large. But shareholders are also members of the society. Shareholders are they have the residual claimant of the business. Shareholders are the ones that own the business. So we are in business to maximize shareholders, but the primary objective of management is to maximize shareholders' wealth. All right, we'll talk now about cash flow. There are three aspects of cash flow that affects an investment value. An investment value. When we talk about an investment value, that intrinsic value, that price of an investment, the three things that tend to affect the cash flow of an investment value. Number one, the amount of expected cash flow. If you are considering an investment and the expected cash flow is very large, then the value of that investment is going to be large as well. So the amount of expected cash flow will affect an investment value. So the bigger, the better. The second thing is the timing of the cash flow stream. If the investment is going to generate cash flow sooner than later, the better, because we want our money as quickly as possible. And then number three is the risk of the cash flow. The less risk, the better. So risk is the variability of cash flow, that there's a possibility that there can be a high cash flow coming in, and there could also be an extremely low cash flow coming in. So such a cash flow poses the risk which means one can be out of the money. So the less risk, the better. Free cash flow. How do we define free cash flow? Free cash flow are the cash flow that are available for distribution to all investors. It's the cash flow that is available for distribution to all investors, which means that once a business makes a sale, so there is sales revenue, we need to subtract operating costs, we need to subtract operating taxes, then we need to subtract require investment in operating capital. That leaves us with what we call the free cash flow. So basically the free cash flow is, or could be computed by taking the sales revenue minus the operating costs, minus the operating taxes, minus the required investment in operating capital. The next concept we move to is what we call the weighted average cost of capital. The cost of capital. Capital is not free. Businesses need capital to run. So they need to understand their cost of capital. What is the cost of getting money? Of course, businesses can get money through different ways. Corporation, in the large part, they can get money through the issuance of stock. So that is stock financing, which could be equity financing. Another type of stock is preferred stock. So they can raise money through the issuance of preferred stock. So that's preferred stock financing. Or they could also raise money through the issuance of debt. That is debt financing. So in understanding the cost of capital, the weighted average cost of capital is what they need, the WACC. So WACC is the average rate of return required by all investors of the company. It's the average rate of return required by all of the company's investors. So before we come to this, I already mentioned that companies tend to raise money through preferred stock, equity financing, and through debt. So weighted average cost of capital is really a combination of all this cost of capital. It's a weighted combination of the cost of equity, the cost of preferred stock, the cost of debt, the cost of debt. So once a company understands the weighted average cost of capital, it helps them in their investment decision. Before they can invest in any project, they want to be sure that that project is generating a return that is greater than the cost of capital. So just think of this. If it's costing the company, say 7% in capital, which means when they raise capital, it's costing them, they need to pay back that capital and pay an additional 7%. If the company needs to take that money raised and invest it in any project, they need to ensure that that project is generating a return that is greater than 7%, a return that is greater than the cost of capital. So you can see why the weighted average cost of capital is important, because it now helps the company to gauge an average rate of return required for any investment. So every investor wants to be sure that the return they are getting when they invest in the project is greater than the cost of capital. There are some things that can affect weighted average cost of capital. The capital structure. I already said this capital structure is largely made up of debt, equity, and by equity, we are talking about preferred and equity financing. So the capital structure, what is the percentage of debt relative to preferred stock, relative to common stock? So that's the capital structure. That is going to affect the weighted average cost of capital. Also the interest rate. If interest rate is high, we expect that the overall cost of capital is going to be high. Also, the risk of the firm. If risk is extremely high, then the cost of capital is going to be high. Also, investors' overall attitude towards risk. If investors are extremely risk adverse, then they would require higher compensation for any risk they take. So all of that will affect the cost of capital. So the cost of capital we just discussed about helps a business to be able to calculate their intrinsic value, the true value. So intrinsic value is the sum of all the future expected free cash flow when converted into today's dollar, which means we are taking all future cash flows, calculating the present value of each of those cash flows, and we are adding them up. We are summing them up. That will give us the intrinsic value of the firm, the company's fundamental value. Again, value is really made up of all free cash flow. So if we can understand free cash flow, all future free cash flow, period after period after period, we can basically compute the present value of all of those cash flows, and then we add them up. That is going to give us the intrinsic value of the company. So in calculating the present value, we need that discount rate, that interest rate. The rate that is being used is the WACC, the weighted average cost of capital. So to put it in a diagram that gives us a bigger picture on how we determine intrinsic value. So we want to understand how we arrive at the free cash flow, which we already mentioned, that free cash flow is the sales revenue minus the operating costs and taxes minus the required investment in operating capital. And that will leave us with free cash flow period after period. Then we need the weighted average cost of capital. That is going to be the discount rate that we'll use in calculating the present value of each of the free cash flow. This weighted average cost of capital is really based on the cost of debt and the cost of equity. The cost of debt and equity is as a result of the firm's debt equity mix, firm's business risk, the market interest rate, and the market risk aversion. So that will help us in getting our weighted average cost of capital, which we now use in calculating the present value of each of the free cash flows, sum them up, and that will give us the intrinsic value of the company. Who are the borrowers and savers of capital or of funds? Who are the providers? So the providers are savers. And who are the users? The users are borrowers of capital. In general, households tend to be net savers. Most households, we have an account with the bank, whether it's a checking or a savings account, and we put money there. So we tend to be net savers. We are saving our money. And then what do we expect? Businesses who borrow the money. So businesses, precisely non-financial corporation, they tend to be net users or borrowers of funds. So they go to the bank and they borrow this money that is coming largely from household, and they use the money in running their business. The US government in general is a net borrower of funds. So the borrow fund, but there are other foreign governments that are net savers. So the government really act as both a net saver and a net borrower of funds. Financial institutions are also midway. They are slightly net borrowers, but sometimes they tend to break even. So they are savers and borrowers at the same time. But by and large, household had net savers and non-financial corporation net borrowers of funds. So this is how the capital allocation process can be separated. So there are three parts. We have what we call the direct transfers, and then we have transfer through an investment bank, and then we have capital allocation through a financial intermediary. So if it is a direct transfer in panel A, we see that the business is in need of money and they get the money directly from the provider of funds. So the user of funds is getting money directly from the provider of funds. So the dollar is coming from the provider to the user, and then the user is issuing business security to the provider of funds. That's direct transfer. Capital allocation can also take place through an investment bank. So we have a business that is in need of money. They get money from the provider of funds, where the provider of funds actually put this money with an investment bank and obtain a business security from the investment bank. The investment bank in turn give the money to the business, and the business issues a business security to the investment bank. So the business is getting money from the provider of funds through an investment bank. And then in panel C, it is capital allocation through a financial intermediary. So we have a business that gets money from the provider of funds, but the money is going through a financial intermediary. The provider keeps money with the bank and they get a security, business security. And then the financial intermediary give the money to the business and the business issue an intermediary security to the financial intermediary. So capital allocation process can be number one, direct, number two, through an investment bank, number three, through a financial intermediary. And we have examples. An example of a direct transfer: a corporation issue commercial paper to an insurance company. So the insurance company is dealing directly with the corporation, direct transfer. An example of an investment banking house, which is capital allocation through an investment bank, is an IPO or a seasonal equity offering or a debt placement. So the company sells security to the investment bank, and then the investment bank in turn sells the security to investors. So there's an exchange of money, but that exchange is going through an investment bank. So this is really the case of what we call firm commitment, especially when we think about IPO. So a business is being incorporated and they have shares to sell. They contact an investment bank. They sell all those shares to the investment bank. The investment bank takes a firm commitment to buy them, and then they intend to sell them to the general public. So that business is getting money from the general public, but the money is going through an investment bank. We also have capital allocation through a financial intermediary. An example: an individual deposit money in a bank and gets a certificate of deposit. The bank makes commercial paper to the company. Bank gets note from the company. So the individual is actually getting money from this company mentioned in this example, but it is going through a bank because that individual makes a deposit in the bank and gets a certificate of deposit. So there is an individual that is depositing their money, but that money is being extended to the business. So the business is getting money from that individual through a financial intermediary. All right, the cost of money. So money is not free. There is a cost that is associated with getting money. So we can also say the price the price of money, the cost of money. If we think about interest rate, for example, interest rate is the cost of debt. If you go to the bank and you are in need of money, once you get a loan, you need to pay back with an interest. So that interest rate you are paying back is the cost. So that is the cost of getting money. So interest rate can be seen as the price of debt or the cost of debt capital. As far as equity is concerned, the cost of equity is required return, and the required return can be split into dividend yield and capital gain. If a company decides to issue equity, so they are raising money through equity, there is a cost that is associated with that. That cost is the dividend yield, because the company needs to pay dividend to investors. And then also the cost that is associated with equity is capital gain. As the stock is appreciating and the money is going to investors, that is money that could have stayed in the company. So it's costing the company. So the cost of equity or the required return is the dividend yield plus the capital gain. There are 4 factors that affect the cost of money. Number 1, production opportunity. Number 2, time preferences for consumption. Number 3, risk. And number 4, inflation. So all of this will affect the cost of money. High risk, high cost. Inflation expected to go up, high cost. Time preference of consumption. If we want to consume now rather than later, high cost. Production opportunities. Production opportunities going up, it tends to affect the cost of money. What economic conditions affect the cost of money? Federal Reserve policies. Federal Reserve policies tend to affect the cost of money. Interest rate being stepped up by the federal government affects the cost of money in different areas. Budget deficit and surpluses is an economic condition that affects the cost of money. The level of business activity, whether there is a boom or a recession, it affects the cost of money. International trade deficits and surpluses tend to affect the cost of money. All right, let's talk about financial securities. Financial securities tend to be classified as money market or capital market. So money market securities are securities for the short run, whereas capital market financial securities are securities for the long run. So in terms of debt, money market securities include T-bills, certificate of deposits, euro dollars, and Fed, no equity. As far as derivatives are concerned, options, futures, and forwards. Capital market, on the other hand, capital market financial securities are securities for the long run. So long run basically implies that the cash flow that is coming out from those securities go beyond one accounting period. It goes beyond a year. So debt securities that make up capital market securities include T-bonds, agency bonds, municipal bonds, corporate bonds. Equity will include common stock, preferred stock, and derivatives will include long-term equity anticipated securities and swaps. Some financial institutions, to name them quickly, include commercial banks. Most of us are connected to commercial banks. They have the primary responsibility to receive deposits and they issue loans. Investment banks are also example of financial institution. Investment banks largely help businesses to go public or to sell seasonal offerings. They also give investment-related advice on things like merger and acquisition. We have what we call savings and loans, financial institutions that chiefly are there for mortgage loans. These are examples of financial institutions. So savings and loan, mutual saving banks, credit union. Then we have life insurance companies. We have mutual funds and exchange traded funds. We have pension funds, hedge funds, and private equity funds. So these are all financial institutions. What are some types of markets? A market is a method of exchanging one asset for another asset. Exchanging one asset, usually cash, for another asset. So the formation of markets have really helped to facilitate exchanges to take place. But the different types of markets, it can be markets for physical assets against market for financial assets. So by physical asset, we mean tangible or real asset markets. This could be wheat, it could be auto, it could be real estate, etc., etc. Financial, we are talking about things like stocks and bonds. We can also contrast spot against the futures market. So with spot is the market for right now, that assets are bought and sold on the spot. With the futures market, the price is agreed upon right now, but deliver on a future date. So that's the spot versus the futures market. Then we have the money versus the capital market. Anytime we hear money market in finance, it is short term and it is liquid. So a liquid short-term market is what we call money market. On the other hand, capital market include things like debt and stock long-term. Debt and stock long-term. Then we can also contrast primary versus secondary markets. So primary markets and new markets where we have the issuance of IOPs, initial public offerings. Secondary markets, they are markets that sell already outstanding security. All right, let's talk about primary versus secondary security sales. So primary is where we issue securities for the first time. So new securities, initial public offering are issued. So that's a primary market. So the key factors include that the issuer received the proceeds from the sale. So think a company like Facebook, when it started, it was privately held. And then later on, Facebook went public. When they are selling IPOs for the first time, the proceeds, the amount of sales end up with Facebook. It's not the case with secondary market because those who bought Facebook at that time, they have shares. They can intend sell their shares. That will be a secondary market. But when they sell their shares, the money is not going to Facebook. The money is coming to them. So primary market is the market for the issuance of new securities or new issues, IOPs. Secondary is existing owner sell to another party. A key factor is that the issuing firm doesn't receive the proceeds and it is not directly involved. The issuing firm is not directly involved. Along what two dimensions can we classify trading procedure? So by location, we can have a physical location exchanges where trading is face-to-face, or we can have over-the-counter or what we call computer or telephone networks. So as far as location is concerned, it can be physical or it can be through the computer. So we can talk how orders from buyers and sellers are matched. How are orders being matched? It could be through an open outcry auction with face-to-face trading. Face-to-face trading. With an open outcry auction with face-to-face trading, it can be on the centralized trading floor. We can also have orders being matched with the use of dealers. These are market makers that they buy from and sell to clients. And then we can also have automated trading platforms that match orders and execute trade automatically. So it can be matched, orders from buyers and sellers can be matched through an open outcry with a face-to-face trading. It can be matched through the use of dealers, or it can be matched with an automated trading platform. So type of orders, transactions on how a transaction is to be completed. We have what we call market order, and we have what we call limit order. So there is a market order and the limit order. So with market order, there is transaction is actually done quickly as possible. So you transact as quickly as possible at the current price. I want to buy Walmart, for example, you send that order to a broker and it executes at the market price. That is a market order. So the transaction is done quickly at the current market price. We have what we call limit orders. It transacts only if specific situation occur. For example, buy if prices drop to $5 per share or below during the next 2 hours. If you leave this kind of order in the system or with the broker, that is a limit order. So the transaction only occurs if prices reach a certain level or below. So those are types of orders. Let us talk about New York Stock Exchange versus the NASDAQ. The New York Stock Exchange is the largest US registered stock exchange. Of course, we can say it's the largest stock exchange in the world. So the NASDAQ stock market has the most listing because it is willing to list smaller organization than the New York Stock Exchange. The New York Stock Exchange mostly lists larger organization. So listing have a more bigger market value than the NASDAQ listing stock. So the NASDAQ will list a lot of smaller stocks, whereas the New York Stock Exchange lists larger stocks. So we can see here a comparison between the New York Stock Exchange and the NASDAQ. So in terms of number of listing, 3,274 companies listed on NASDAQ, and this is as at December 2017. So while we have 3,274 with NASDAQ, we have 3,133 with New York Stock Exchange. So even though New York Stock Exchange has a lower listing, but in terms of market value of listing, it has in its hand about $27.9 trillion, whereas NASDAQ has just $11.3 trillion. So NASDAQ the highest number of listing, but the smaller market value of listing. New York, a smaller number of listing, but a larger market value of listing. Right. Owners of trading volume. And what we find here, if we look at total trading on all exchanges, and this is global market, NASDAQ, Intercontinental Exchange, which include New York Stock Exchange. So the total trading on all exchanges is about 65%. We also have total trading on all other exchanges. This includes dark pools, broker-dealer networks, retail trade, and institutional trade. We add all of those up, it comes to about 35%. So more of trading occurs on an organized exchange. All right, as we wrap up this chapter and this presentation, let's talk quickly about home mortgages. Home mortgages before savings and loans. So we had mentioned before that savings and loans are financial institutions that are there to lend money chiefly for home mortgages. So they lend money chiefly for home mortgages. So before savings and loan were on the scene, there was a big problem with individual investors that were trying to lend money to aspiring homeowners. So some of the challenges is that these individual investors might not have enough money to fund an entire home. They need to lend. They need to give money for people to buy their homes. Individuals might not have enough money. Another challenge is that individual investors might not be in a good position to evaluate the risk of the potential homeowner. Individual investors might have difficulty collecting the mortgage payment if they are extended that mortgage payment. So these were challenges that were there before the arrival of savings and loans. People were aspiring to be homeowners, but they needed to look on individual investors that had problems with giving them the amount of money that they need, evaluating the risks that is attached to those that are asking for the fund, and they also had problem with collecting mortgage payment. So savings and loans came on the scene, and they were able to extend loan to individuals that were in need of money for their homes. And this was possible because savings and loan will pool deposits from many investors. So once they do that, they are able to have enough money to lend. Then they will also develop expertise in evaluating the risk of borrowers, something that individuals could not do. They also had the legal resources to collect payments from individuals. So they came in to close the gap that was there before. We'll now see that savings and loans still faced a significant problem. So they were limited in the amount of mortgages they could fund by the amount of deposits they could raise. So on the one hand, they could raise some money, but it was challenging for them to be able to fund requests for all the different good mortgages that were being requested. So one of the major problems is that savings and loan were raising money through short-term floating interest rate, and they were giving out loans in the form of long-term fixed rate mortgages. So there'll be a mismatch. When interest rate is high, for example, savings and loan tends to face crisis because they had to pay more to depositors than they collected from mortgages, because their mortgages are pretty much fixed, but their loans were on a variable rate. So if interest rate is going up, they need to pay more than more is actually coming in from the loans they had extended. So this huge problem led to the bankruptcy of so many savings and loans in the 80s. And because deposits were insured, taxpayers ended up paying hundreds of billions in dollars. So after the crisis in the 80s, savings and loans now put mortgages into pools, and they sell those pools to other organizations such as Fannie Mae. So savings and loans, once they had issued out these loans, instead of keeping them in their books for a long period of time, collecting monthly payment, that period of time could be maybe 20 years, 30 years loan. They were now able to securitize these loans, which means they take all those mortgages, they put in pools, and then they sell them to organizations like Fannie Mae. So the risk is shifted to Fannie Mae. So the savings and loans actually shift their risk to Fannie Mae. So the risk does not disappear, it is basically shifted. Fannie Mae, on the other hand, further develop mortgage-backed securitization, and they sell it to investors. So investors tend to have more risk, and more risk is expected to be associated with more return. So this process of putting loans or mortgages into pools and selling them is really what we call securitization. There are other assets that can be securitized. They include mortgages and they include car loans. Car loans can be securitized. Student loans can be securitized. Credit card balances can be securitized. So just taking these loans and putting them together in a pool and selling them to other investors. And then when the stream of payment is coming, car payment, for example, that is going to those who own these securitized papers. So the dark side of securitization, homeowners wanted better homes than they could afford. So there was pressure on the banks, and these banks tend to give mortgages to homeowners that were unable to pay. And the banks were very happy doing that because they will securitize these loans anyway. So they believe that they were transferring the risk to another, to the investor of this securitization. So that can be the bad side of securitization, that it can promote what we call originate to distribute. So banks had basically worked with originate to hold. So they originate loans and hold them on their balance sheet. If you think of mortgage loans set up for 30 years or 20 years, banks were holding those in their balance sheet for that length of time. But with securitization now, they can quickly put those loans into pools and then sell them, which means that there is the temptation for banks not to do their due diligence with the loans that they are issuing, because they'll securitize those loans. So that is the dark side of securitization. So some of these banks could also secure credit to protect themselves, collateralize debt obligation. But again, this risks were never disappeared in the system. They were basically transferred from one person to the other, and it eventually led to the collapse of the system. When mortgages reset and borrowers defaulted, even the value of the collateralized debt obligation plummeted, and this resulted in a serious problem in the system. So many of the credit default swaps fail to provide insurance because the counterparty failed. So the dark side of securitization actually led to the 2007-2008 financial crisis. That brings us to the end of this chapter. Thank you.